Okay, so right, so chaos in the UK bond markets. This is my take on why. Right, so it's all starting with the pension funds. So a pension fund basically is workers pay in to the fund over their working life, and that's the asset, or that contributes to the asset of the pension fund. The liability side of pension fund is when those people then retire, and then payments are made monthly during the life of the pensioner. This is normally referred to as longevity. I'm going to focus today on interest rates because it relates specifically to the chaos in the bond markets that we've experienced over the last week or so. So pension investments. So the cash comes in, and then this cash is generally invested into various different products. There's quite a lot of products, which includes commodities, soft commodities, gold, silver, equities, and bonds. And the idea is we take this cash, invest it to produce more cash as time goes by. And various things affect this, such as inflation, interest rates, and so on. So the two main investments of a pension scheme or a fund, bonds and equity shares. So you might invest in a property fund, or you might invest in blue chip companies, and these are controlled by regulation. So a pension fund can't go and gamble your money in South American futures, for example, which is high credit risk and highly volatile, and your money could just disappear. So what we want to discuss briefly is bonds. So a bond is effectively an IOU. There are different types of bonds. I'm just going to do a quick example of what they call a discount bond, and that's just basically a bond where you pay the IOU value, or the face value of the bond, is sold at a discount. So, for example, the investor would pay the Bank of England for a bond that matures in 1 year time with a face value of £100, and these are then auctioned off. And of course, I've made these numbers up. But if you paid £90, that would imply approximately an interest rate of 10%. So effectively, they're promising to pay you £100 in a year from now. And that will be one payment, a bullet payment. And that's kind of like how an IOU would work, and that's how a discount bond works. So the investor pays his 90 quid, waits for 12 months, the Bank of England will pay him £100 back. And you can see that under simple interest, quick calculation doesn't quite work like this because it's usually compounded in some way, but it's approximately 10%. So great, the investor will make a tenner. And at the moment, that would be a good return, for now at least. Right, so the guy makes 10% on the bond investment, and that's great because I can only get 8% in my savings account. So he's obviously beaten the market for the local building site or whatever. The rates do tend to be fairly close because a government bond is considered to be pretty much risk-free. Right, 6 months later, the investor needs his money back. Now, obviously, this is a contrived example. So he goes, he's bought his bond direct from the Bank of England, which that would not normally happen. You would still go through an intermediary. But let's, for argument's sake, assume he's bought it straight from the Bank of England. That's termed the primary market. So he wants his money back early, and of course, it's a tradable bond, so he can go to a broker and sell it. So the investor asks the broker for a price, and we've got brokers who sit in the middle between the seller and the buyer, and the secondary market will be full of buyers, and they'll be looking for bargains. So the broker will offer the investor £80, and he will sell that with a spread to the secondary market for whatever the bids are. There's a little bit of risk involved in the broker here because he's got to match up deals on both sides. So when there's more sellers than buyers, then the price quickly comes down to attract buyers, and vice versa. So the investor he's going to sell his bond 6 months before maturity, and he's going to lose £10 on his investment in this fake scenario. So he's going to buy. So the bond broker wants to buy it for 80, and he wants to sell. He's asking for 83, and he'll make that £3 in the middle. So the investor sits down and thinks, well, why have I lost money? Well, you bought the bond when interest rates were 10%. Now in this scenario, I made this massive increase to 30%, and the broker he's got to sell that based on the return that the secondary market investors are willing to pay. Now, the way he can attract, obviously, these buyers in the secondary market by lowering the price if there's an imbalance between buy and sell, which is not the norm. Normally, there's more. Normally the market is pretty well matched up, and so therefore you will get the calculated rate of return. So the obviously in this case, the buyer would want a 30% return, which is 15% over 6 months. So the alternatives are to wait 6 months more and receive the £100 face value of the bond, and making that 10% profit because it originally paid £90 for it. If you sell the bond on the secondary market, then you're going to lose a tenner. So you're effectively selling a 6 month bond that pays £100 in 6 months' time, for which you paid £90. The interest rates have now risen to 30% in this fake scenario, and the new buyer wants to gain at least 15% over 6 months, which is just half of that 30%. There will be very small differences when you bring in compounding factors, so it won't be strictly 15%, but it will be near that. A new buyer will pay a maximum of £85, let's say. The broker will take £3 for his profit and risk, and the risk for the broker is not being able to match up the bond in a falling market and then being stuck with it, so they've got to be pretty quick. And the broker may offer you even £2 less if he can't attract a buyer. So it's not just the basic, well, in the normal circumstances it will just be the current interest rates and the interest rate payable on the bond. Then you'll calculate the exact price, and that's normally what it would sell for in a liquid market. But if there are more sellers than buyers, which will be important to note in a bit, then the price of the bond can come even lower, because the broker's got to set a price that will attract a buyer to take on that risk. Now, if interest rates are expected to rise, or even people think it might rise, there may be few people willing to buy unless the price is low enough to cover their fears and expectations. And that's basically what's happening. Right, so that was a discount bond. In our discussion of bonds, we used a simple example. A discount bond pays no interest during the life of the bond, so you just get your cash back at the end, which is the face value. And that face value in this case, this example, is £100, of which our investor paid £90 for. So it's yielding around about 10%. Right, so to round up, that's how a bond works. In our discussion, obviously I tried to simplify it as much as possible. And a discount bond doesn't pay any interest or coupon payments, as they're technically called. And so they're just sold cheaper than the face value, depending on the current interest rate and the fixed rate and the principal of the bond, or the face value. Longer term bonds, which mature and pay back your money, mostly pay an annual coupon. This is an interest payment which is fixed for the life of the bond, and then at the end of the period, so if that was 20 years, you might get 5% per year for the face, based on the face value of the bond, and then at the end of the life of the bond, you'll get your money back. So because bonds pay a fixed rate, when interest rates go up, bond prices fall, and vice versa. So rates go up, bond prices go down, rates go down, bond prices go up. And this is to match up the present value of all those cash flows, including the final payment. And that's a simple calculation. So again, when we look at longer term bonds, which mature and pay back your money with annual coupons, the insurance companies use these coupons to pay out their pensioners after they retire. And they do this by holding, obviously, a large number of bonds in an extremely large portfolio that can be hundreds of billions and, in some cases, for the larger funds, trillions. So it's kind of important to understand that you've got the cash flows coming in off the portfolio of bonds. This could be hundreds of millions. So basically, a pension fund will buy bonds of varying maturities, and this is called term structures. So, of course, they will have liabilities to pay today, so they'll want cash income from longer term bonds. And as they come up to maturity, then they will then reinvest that cash to buy more bonds. And if the pension fund is fully funded, which you would hope they are, although typically they're not, then the amount of bonds and the income from them will be paid out to pensioners, and everybody's happy. Now, a lot of these pensions are also what they call defined benefit. So whatever happens in the world, whether inflation suddenly spikes as it is doing at the moment, or interest rates go up or go down or whatever, that pension fund has an obligation to pay the pensioner whatever that agreement is. And sometimes the pensions are linked to the retail price index. So if you think about current times where inflation has gone up, and the value to the pensioner obviously will be less, but if it's index linked, then the payments will increase, and then that falls on the pension fund to make up that shortfall. So it's quite a risk. That's where the risk is in pension funds, and it's being able to match your investments along with your liabilities, which is the pensioners who you're paying, and you also don't know when they're going to die. I mean, they might die 6 months after they take the pension, which knowing my luck, well, I haven't got a pension anymore, but if I did have one, knowing my luck, yeah, my investments would have disappeared into the wind, like most of the things I do. But some people have got the impertinence to live well beyond the average. And of course, this can be handled by the pension funds in different ways. There are longevity instruments that you can enter into, which is kind of an actuarial valuation. But just for this specific problem within the markets this week, we'll just focus on interest rates. And we've already said if interest rates go up, bonds prices go down, and if interest rates go down, and vice versa, so the bond price goes up. Protecting against an adverse change in interest rates. So as we've discussed, the movement in interest rates and other factors, but in this case specific, we'll focus on interest rates, can change the business model. And effectively, if the pension fund is not earning enough interest on its investments, then it wants to try to protect itself against that. And there are contracts known as swaps, and a swap can be anything from an interest rate swap on fixed for floating rates, which will be the hedge if you've got a fixed rate mortgage. So you pay the fixed side of that swap. It won't just be you, but there'll be thousands of people in the set on the back of the same swap instrument. You'll pay the fixed side, so you know what you're going to have to pay. You're comfortable, you can budget for that, and if there's any adverse movements in rates, it doesn't matter because you're fixed in. And I hope you're fixed in at the moment because rates are definitely going up. Or there can be one floating rate to another. So, and these tend to be called basis swaps. So you might be swapping one rate on the same interest rate curve, so 6 months versus 12 months or something like this. There's very good reasons for doing that, which I won't go into in case you get too bored. Right, so another swap can be made, and often they've got barrier levels in them. So if you can enter into a swap with a financial institution, which is typically a bank, where you will pay when a certain benchmark yield goes above a certain rate, or they pay you when the yield is below a certain rate. And if you think about it, what a pension fund is really doing there is saying, right, if interest rates drop so low that they're not getting any income from their portfolio, or not sufficient income from the portfolio to meet their liabilities, i.e. paying the pensioners, then the financial institution will pay them. And these are very large notionals. So it might be 100 billion notional, and I've made these numbers up here, but you can get the drift. If interest rates drop below a certain level, you may not be able to meet your liabilities. So pension funds enter into these contracts to support the payments of the liabilities. And that is the cash flows to the pensioners, the monthly income. Now, typically in these swaps, it obviously can't just be the financial institution always having to pay the pension fund. And so the contract will say, okay, that's fine. We'll pay you if the interest rate drops below a certain amount. But then you have to pay us if it goes above a certain amount. And those two amounts are not necessarily the same. So there could be, and usually is, a gap between them. In this example, I've just made it simple. If the yield on the bonds goes greater than 2%, means the pension fund has got extra cash, or it will get extra cash as it buys new bonds and replaces them. And then we'll pay back we'll pay a cash flow to the financial institution based on that notional amount, which can be billions, or 2% of billions, or whatever, or the difference between 2% and the current rate times billions. So these are not small numbers we're talking about in real life. And this is a protection, and they're all calculated such that it shouldn't really happen. And the movements either side, when the price of swap on day one, the price is absolutely balanced and therefore it's zero, so nobody really pays anything. But a pension fund does have to put up collateral to back the swap just in case it goes against them. So if the rates do go above 2% in this case, and they have to pay, then the financial institution will require collateral. That will be important in a sec. Right, so when interest rates are low, the pension tops up with cash flows from the financial institution, meets its liabilities to its pensioners, all well and good. This ensures the pension funds have enough money to pay pensioners when the interest rates go too low. I think we've covered that. The opposite case, again, when bond yields go above 2%, then the pension fund pays the bank. And typically, it might be something like 1.5% the lower barrier, and it might be 2.5% or 3% the upper barrier. And then both sides would rather like rates to stay between the two, and nobody pays anybody. So it's a risk management tool provided by the banks to the pension fund. And typically, an investment bank getting into these deals are there to take on the risks of the pension fund. But of course, that can work both ways. Right, so what went wrong? So the bond yields, if you look at this chart that I've nicked off the internet, the bond yields have been rising since the back end of 2021. Around about December 21, it's kind of edged downwards as we've come out of lockdown and everything's started to function normally. So if you look at over that last year, you can see that it's been rising ever since. In fact, it goes all the way, a little bit of a dip in July, but it's kept going all the way up to around about the beginning of September. Then it spiked. It spiked about 0.9%. This is the mini budget, but as you can see, it's come straight back down. So this is the area that's causing can you believe, is causing all of the chaos. Now, the reasons for these are obviously we're in difficult times. They're typically termed externalities, which means things that you've got no control over. So in risk management, you would say, well, we have to simulate these externalities and see what the effect is on our portfolios and credit risk and market risk and other risks. So after the effects of global pandemic and the war, and now the war in Ukraine as well. So we had all these supply chain issues around the global pandemic, and then of course we've got the war in Ukraine to deal with as well, and that's given us this upward movement in the bond yields. Now that bond yield also, because we've said that when yields go up, bond prices go down. Remember, the payments are fixed from the bond. So if the bond price falls, the yield rises. Just in the example at the beginning, when interest rates go up, then the bond price comes down. And if you have to sell before maturity, then this can cause a problem. Now, the thing about bonds is if you hold the bond until maturity, as long as the government doesn't default, which we never have done in the UK, so in 20 years' time, whatever this bond is, which is a 20-year gilt, you will get the full face value back. So that might be £1 billion or whatever it is. In the meantime, you'll get your coupon payments. Now, as I said, the UK government has never we've been through 2 difficult wars in the last century and everything else. We've never defaulted on our payments. So the credit risk on a government bond, despite whatever the rating agencies give the bond, is AAA. And that's not going to change anytime soon. We've been in much worse situations than this. Right, so there are 2 bits that the pension fund have to pay. When the yield has gone above the barrier, it then starts having to pay the financial institution. These are your normal cash flows. But as we've said, when the yields go up, that's reflecting the fact that the bond price has gone down, and the swap contract will be collateralized, probably on the value of the bond. As that bond value falls, there will be a gap between the collateral required by the financial institution and the value of the bond. Or it doesn't have to actually be there, but if it would be written into the contract, if the financial institution thinks that there is a possibility that you're not going to be able to meet your payments, and this is termed default, in those circumstances, the financial institution will call collateral. Now, they need to do that because they've got to cover their what they call risk-weighted asset exposure. And this would be a derivative and therefore a risk-weighted asset. So the government will expect them to have their exposures fully collateralized. Now, the thing about that is the pension fund's now becoming in a no-win situation. It pays because the yields have now risen, the bond prices has fallen, so its assets have fallen and its obligations have increased. And then you've got on top of that the collateral margin that's being called by the financial institution because the bond price has increased. So it's a double whammy for the pension fund, which is unusual, but this is what's happened. Right, again, because of this, and this is kind of a systemic issue, you've got basically, and all pension funds are in this position, a vicious circle develops. So what we've got is a lowering of bond prices, collateral and payment increases. The pension fund can't meet the obligation without selling a bond, because most of what they have on the books are bonds. So they sell bonds, everybody's selling them, and obviously you've got the secondary market buyers probably less. So you've got more sellers than buyers. So the bond price falls. The bond yields therefore rise as a result of the fall in the bond price, as we've looked at previously. And then the collateral and payments increase. Then you've got to sell more bonds. Then the bond prices fall, the bond yields rise, collateral and payment increase. So as you can see, this is a vicious circle. And the Bank of England obviously gets to see this, well, probably lots of people screaming down the phone, where if this were allowed to continue, then the bond prices would collapse. So when they say rescue, what they're really doing is becoming a buyer, and they won't be bidding in the same way that the market would. There aren't enough buyers, and so everybody's selling. Bank of England steps in with its own resources and buys up the bonds. Now, they don't need to buy much. They always say we'll buy as much as we need to do, but what it does is it returns stability back to the market. The bond prices stop falling. The whole thing stabilizes. And if I just nip back to here, we can see this is what happens. So it spiked 1% in a couple of days. That's very unusual, and that's an extremely large move. But it immediately fell back to practically where it was. So this vicious circle is what the Bank of England would refer to as a dysfunctional market. This is not how it normally works. It's just that everybody's in the same boat. The vicious circle has started. The financial institutions are making their collateral calls, which means that they have to pay collateral plus the payments within the swap. This is a derivative contract, so it's based on the notional value of the bonds. And whilst this looks like a right simple diagram here, this represents the whole dysfunction of the markets in a nutshell. So is it the UK government's fault? All right, so if you read the papers, and I've got a clip here from The Guardian, where you've got all of these, frantic stories, the whole world's going to end. There's a scramble to stop the financial crisis, and so on and so forth. No, not really. It's not really the government's fault, as we can see from the chart here of the 20-year bond. I don't just pick that; it could be anything 20 years or above. It will show a similar pattern. These things have been happening over the last year, basically. It's been rising, couple of dips, but it's on its way up. And it was around about this point where the mini budget started. But you can't honestly blame all this increase here on that mini budget. Now, I'll go into that in a sec. So what I've noted here is we've seen the slow and deliberate rise in bond yields since the end of 2021. There was always likely to be a Bank of England intervention sometime, because it was already too high, and Japan had already done so a few weeks earlier. So it's not basically the UK that's the problem. It's the whole world, well, except for the US, and that's because they've got plenty of oil and self-sufficient in pretty much everything. Plus, everybody wants the dollar because they use it to buy practically everything from commodities through to whatever. The government's mini budget didn't provide any detail on how spending plans would be achieved. This makes markets nervous, because all they then see is, they're going to just generate more and more of this debt, and then people then start to think, well, they're not going to be sold at auction, and blah blah blah, this and the other. So that creates nervousness. So in some respects, what the government should have done in the mini budget is fully costed it, which they intend to do in November. I can see why they didn't wait for that, because obviously the biggest portion of what they're doing is capping the energy price. That's extremely important, not because I want to, pay less for electricity. The energy prices and the impacts of the energy prices are causing pretty much all of the inflation. So by capping those prices, they're able to get inflation under control. They probably don't care less really about consumers or business at the Treasury, but they do know that capping the energy price obviously will lead to a reduction in inflation, because it's not just it's practically all caused by energy prices, because it's not just the price of energy, is it? It's the industry runs off it, transport and distribution, logistics. It's all based on being able to buy fuel at reasonable costs, and therefore that energy inflation price feeds through into food and other things, because it's got to be grown, moved about, and so on and so forth. And that was the main increase in the expenditure. The mini budget did not specify the cost of the tax cuts or how they'll be covered. And so then anyone can step in and say it's going to cost this, that and the other. That's exactly what they've done, especially the media, who they've put a price of 50 to 60 billion on it. Now, I've had a quick look at that, just very, very rule of thumb, and I may have got this wrong, but I don't think so. So what will the tax cuts really cost? Well, there's actual tax cuts. Income tax amounts to about 1.9 billion. Stamp duty, 900 million, which is okay in the big scheme of things. It's a drop in the ocean. And then they've also scrapped proposed tax rises. Now the NI I've worked out is 1.25 billion, and corporation tax at 7 billion. Now I've seen estimates from the Institute for Fiscal Studies saying that this is 17.5 billion. That's not strictly. I just don't know how they get to that number, because there's not enough headline corporation tax to arrive at this figure over a 6% rise. And I know it's tapered, but it can't be any more than 7, and it's probably less. And again, that gives a total, including NI and everything else. So in other words, the scrapping of the tax rises and the actual tax cuts of about 11.05 billion. On top of this, of course, you've got the energy price cap cost, but I'm going to keep that separate because everybody's got to do that, and it's the right thing to do in order to control inflation. Whether they care less about whether you freeze to death or not is immaterial. So why is the total lower, my total lower than 40-50 billion being bandied about? Well, I don't know. I mean, my estimates are based on straight line percentages. So, you look at the current revenues, and so, for example, corporation tax is 120 billion quid last year, or thereabouts. So 6% of 120, let's say 10% of 120 billion is 12 billion. Yeah, so I don't know where they get 17.5 from. But again, there might be some subtleties I'm not aware of, but I don't think so. Would this increase in tax cause bond market chaos? No, normally not. Even if the cuts were 40 to 50 billion, and we're going to fund it through borrowing, that's not going to be good. The markets will not take that very well, because they do concern themselves unnecessarily with the credit risk of the bond. I mean, the UK government has never ever defaulted on a bond through the Napoleonic Wars, the First World War, the Second World War, or any other war. So it's unlikely that this is going to be a problem. But some people are saying, okay, yeah, fair enough, but it was the straw that brought the camel's back. Well, that's up to you. Market volatility has been present all year, and it's not likely to go anywhere until the war in the Ukraine ends, and/or inflation is brought back under control. So that's my view of it. Conclusion: we're living through difficult times. Most people's lifetime, we've never seen anything like this. But we've got a war going on, and and obviously the end of the global pandemic, where people were coming back at different levels and speeds. China's still not fully open. They're still concerned about this. This has led to the increased indebtedness of governments, and debt for sustainability is considered to be around 60%. So, for example, the European Union Stability Pact suggests that debt should be around about 60%. Most people are above that now, including Germany. We're hovering around about 100%, but we do own 800 or 900, let's call it 900 billion of our own debt. And while interest rates were low, we were gaining around about, or the Treasury was gaining around about 15 billion quid a year because we own our own debt. So they've bought government bonds through quantitative easing. This increases the money supply and therefore can fuel inflation. The markets have always returned to normal in the past, and they will do again. I'll put my tiny mortgage on that. The next few years are going to be difficult. Interest rates will rise, probably as high as 7-8%. Not for long. So if you fixed for the next year or two, then you should be fine. If not, you're going to have to batten down the hatches a little bit and stop eating takeaways. A new generation of people think these rates are high. The reality is that this is more normal. Most people remember the days where interest rates were 10, 12, 15%, typically 6 or 7. I think house prices are likely to fall because of the high interest rates. So the market will just go flat. Exchange rates will remain weak, at least until inflation's under control, and then we can start having a go at bringing the debt down. which is not something that's going to happen anytime soon. So that's my conclusion. I hope this explains what's going on. It's not dramatic. Well, it is dramatic because the media have made it dramatic, but it's not unusual to have these problems within the markets, and they don't make headlines, if you know what I mean. So there we are. Thanks a lot. Bye.